Welcome to Goshen Prepping. Thank you so much for joining us. Economists are warning that we are heading for another, recession, possibly, more than likely, a depression. Let's look at some articles. From Bazinga, economist flags this is a surefire recession signal. Economy is a dead man walking. And before we jump into it, I just want to say a lot of people said, oh, you're the boy who's crying wolf. And that's exactly what it's saying here. Market pricing in a soft landing. Will they ever be in for a big surprise? Well, the boy who cried wolf indeed, but the wolf did show up at the end of the story. I know it sounds extremely controversial to talk about the U.S. going into a recession, just because the lagging and coincident indicators are telling you we're into something brand spanking new about a no landing or a soft landing. And here's the key for this article. We're heading into a hard landing in the second half of the year. This is strengthening the case for a global recession. And that's so true, isn't it? The government doesn't want to talk about recession. They claim we're not in a recession as they fudge the numbers, making it look like we're not in a recession when we absolutely are. But here's the kicker. When we actually went into the Great Depression in the late 20s, early 30s, they thought they were just in a recession at the time. The way we're looking right now, we're heading in the exact same path. Want proof? Look at this article from the Motley Fool. U.S. money supply hasn't done this since the Great Depression, and it implies something big for stocks. And to understand this, we actually have to look at the money supply, and it actually has two parts to it, M1 and M2. M1 money supply is everything that actually can be spent right now, liquid cash as we call it, bills, coins, money in your checking account, traveler's checks, etc. M2 also includes M1, but also adds things like market funds, savings accounts, certificates of deposit, anything less than $100,000 at financial institutions. You can still spend this money pretty easily, but it's not quite as accessible as M1. And economists look at M2 as the indicator for recession going into depression. Dating back more than 6 decades, M2 has been pretty consistently expanded. M2 has expanded by an average of more than 3% per year. But what's surprising is the M2 money supply over the last couple years. Because of the pandemic, M2 supply ballooned to 26% in a single year. Not 3%, 26%. And the consequences of this, an expansion of M2 allowed the inflation rate to surge above 9%. And here's the key. Just like during the Great Depression, the Federal Reserve does everything it can to cool it off. M2 has now reversed course. For the first time since the Great Depression, the U.S. money supply is contracting, not expanding. So, in plain and simple terms, every time we see this happen with M2, we head into, at the very least, a recession. But again, we also worry about the 30s, the 1930s, when we actually went into a Great Depression. I believe those times are coming again. And as preppers, we need to be ready because we're looking at 25% unemployment rate during that time. People starving, there simply wasn't enough food. If there was, people couldn't afford it. And although right now we see things kind of cooling down, it's because of this is why things are cooling down. In fact, the best way to describe this is the calm before the storm. Thanks for watching.